Hedgeye's Cyber Monday sale is here. This is the best deal we offer anytime on our investment research. Since 2008, Hedgeye's 40-plus analyst team has helped investors big and small navigate volatile financial markets. Now, let Hedgeye help you. Our special Cyber Monday sale features steep discounts on all of our industry-leading investment research. Explore our range of products that can suit your specific research needs. Don't miss Cyber Monday at Hedgeye.
I'm Keith McCullough, and welcome to another real conversation with a gentleman who I think is one of the great disruptors of what I call the old wall, Raoul Pal. Thank you for joining me.
Hello, my friend. Good to see you as ever.
Yeah, you're looking as good as you've looked ever, man. It's like you're like this. You never get older, or what?
I'm trying, right? I'm getting older and trying to fight it now.
You're getting older, but you're getting like out there, like on the risk curve. I've been looking so forward to this because it's rare that somebody that I have a tremendous amount of respect for that's been in the business for a long time makes a big bet, if we can call it that, or a big investment. But secondly, I mean, you could forget more on the way to the bathroom, I think, on the topic of crypto, ETH, Ethereum, et cetera. So I wanted to spend some time. We often spend time, and you've been so courteous with that and giving me an opportunity to explain my process on Real Vision. I'll be eternally grateful for that. But I want to know about yours. I'm long these things. I wake up in the morning. I wake up in the morning like I always do, but I try to put them within my framework. And you can get pretty uncomfortable pretty quickly with the volatility, or at least I do. That doesn't really shake me, but I want to get into that later. First, I want to just start with, if you can start with your framework and your process and how this came to be such a huge position or a huge bet.
So I'd kind of figured out a long time ago, as we all have, that there's a debt issue with the world, and that, when Lehman went bust and things like that happened, nobody knew who owned what. And somebody introduced me to blockchain back in 2012 and Bitcoin. And I thought, you know what, this could be the answer to all of this. So I started investing back then. And I wrote probably the first macro paper on valuing Bitcoin back in 2013. And I basically looked at it in this stock to flow model versus gold. And I thought, with gold at $1,300 at the time, Bitcoin could be worth as much as $1 million, which sounded crazy because it was at $200 then. And I bought it and I held it for a few years and then sold it in the rally in 2017. And then it had been on my radar screen as things were evolving.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.
Then I'd always said that the next financial crisis, the answer to any crisis is now printing of more money, and therefore crypto and macro were going to meet at the next crisis. And it was going to dawn on a lot of people that this limited supply digital asset had true value to create a new financial system and had a store of value property, even though it was extremely and remains extremely volatile. So 2020 comes along, and March comes along and it sells off hard. And I realized that this is the opportunity I've been waiting for. So I kind of started pounding the table, and at that time I was still involved. I had a fantastic bet in bonds that you and I had spoken to, euro dollar futures, stuff like that. I was long dollars, all the usual kind of macro stuff going into that. And you and I had spoken, I think in Feb or early March, pretty much about the same opportunity set that we saw. But crypto started becoming a bigger position because what I did is I started looking at the chart of Bitcoin against other assets. And I'm like, holy shit, this is going to break out versus everything. Mm-hmm. So if this is the time, and us macro guys love a fast trending volatile market, because that's where we make our money. The real money is made in bear markets. For us, we grind it out in bull markets. So I see the opportunity, and I start building my position much more because I'm thinking, well, I don't need to own gold. I don't need to own bonds. I don't need to own equities. I don't need to own anything, just this asset. So that got me to about September 2020. And then I noticed people attacking me when I started saying, Ethereum looks interesting. I thought, oh, that's interesting. They're attacking me for liking something else. It's like if I went to you and said, oh, I like, Canadian bonds versus US bonds. You go, how dare you? You can't talk about Canadian bonds. It's like, it was ridiculous. So anyway, when people start doing that to me, I will go and do the work on it and figure out, are they right? Or is there some crowd illogic going on? So I started looking at Ethereum, thought, yeah, it looks interesting. I always start with the chart. It's my way of framing what the market's been doing and how it feels and the psychology. And then I start doing work on something called Metcalfe's Law. And that is basically a way of analyzing these networks, whether it's mobile phone networks, the internet, Amazon, Facebook. When you look at the number of nodes on the network and the interconnection of the nodes, the more of those two things, the more valuable it is. So I plotted out kind of active wallets and a few other things and did a nice regression line on it, and it was perfect fit with price. And I'm like, oh my God. So then I started looking at Bitcoin and Ethereum and all of the other assets, digital assets, and they're all the same. I'm like, okay, so this is the narratives that are around about store of value and whatever it may be, the internet computer, all of this. Those narratives are driving those communities, but the reality is they were being driven by Metcalfe's Law, and they were all the same thing. Once I understood that, I could now understand the space where I could start looking for network adoption effects. And the moment I opened those eyes, I realized that Ethereum had a much larger, faster network adoption than Bitcoin was having. And I actually started switching my portfolio. Again, everybody hated me for it. I then started buying a bunch of other coins, tokens, stuff I didn't really know a lot about. So I just took a small weighting, like 20%, and of my portfolio, which is now 100% crypto and has been for quite a while now, since maybe May last year. And so I bought a basket saying, well, I'm an idiot. I don't really understand any of this stuff, but I want to see how it trades.
Yeah.
And then then you start to figure out, okay, what are the macro bets within this space that I want to take? Where is this future going? Then we have DeFi, NFTs, all of these things explode over the last 12 months, and you're seeing adoption explode. So my framework is built around Metcalfe's Law, adoption, understanding that this is community driven. It actually charts pretty well as well. And I personally can't short-term trade it. It's too extremely volatile assets are good for really short-term, super short-term traders, but I'm not that guy. My time horizon is 3 months to 18 months. So I just stuck it on and left it. And I've done nothing with it. All I've done is add. And, I've tweaked it around a bit, moving some assets around. And I noticed there seems to be some sort of human behavior that goes on in the space where it trades very similar. So Ethereum is basically trading exactly the same as Bitcoin 2017. And it's been doing that for over a year now. And Bitcoin itself looks exactly like Bitcoin 2013. So it seems to be some crowd psychology, whatever dynamics that's driving it. And that's not going to persist forever. As you and I know, these things can be passing correlations, but it works right now. And it would suggest, along with a lot of other work with, how many coins are in wallets and what's going on, that we should see explosive price action to year end. And in fact, when we look at the Ethereum price overlaid with Bitcoin 2017, this sell-off, this was in the chart a year ago, and it would say, well, it would sell off in early November, and then it takes off and it explodes into year end. Mm-hmm. So it's been weirdly easy to trade with a long-term time horizon. And you and I know that things that are easy to trade don't last that long, but it has been. It's going to get much more difficult because there's now 9,500 tokens. It's not going to be about a bet about Ethereum and Bitcoin. So in 3 years' time, you and I will be talking about lots of different things, not taking away from these two assets, but there'll be less price appreciation. But the other key thing, sorry, it's a big soliloquy here, but the other key thing is that this is the fastest growth of any technology in all recorded history. If Metcalfe's Law is the number of users using the network and their interconnection, well, the internet back in 1997 had 150 million users and was growing at 63% a year. This has 150 million users in the digital asset space. It's growing at 113% a year. So it's telling you the price is exponential. And once I understood all of this stuff, I knew that a lot of macro doesn't make sense. I've got two other macro bets on, Keith. One is carbon futures that I think you and I have talked about in the past, and that's up 100% this year. It's been an interesting trade. And I had a quick shot at being long the dollar, and I closed it out yesterday and made a whopping 4% return. That's the difference. I mean, Ethereum's down 4% today alone. Could it end up 4%, down another 4%? I don't know. But, that was like a 6-week bet in the euro. I nailed it, made 4%. I'm like, really? This is the problem I've got, is the future expected returns in this crypto space because of this adoption and how fast it's all moving means it's the returns are far superior. But as you know, we'll get downside volatility too, and it'll feel like a miserable, shitty world for a while as well.
Yeah, I mean, it's depends on what you've defined as your holding period. I mean, you seem to be quite comfortable being uncomfortable with that, and that's just the way markets are. What I found very interesting there was you challenged your premise with, in I guess September of 2020, with what you and I are very fortunate to have, which is direct feedback from whether it be the Twitter community or our external community of content providers, and you really battle tested, okay, why the hell do I own this thing? And you have your fundamental premise, right? But then you said, then I had to trade it to see how it worked. And that to me is actually, not that you and I have to be the same, but when people ask me, well, how are you comfortable being long wheat and being long, whatever, lean hogs or cattle futures? It's, well, I just trade it. And then if it fits within my framework, then I get increasingly comfortable being uncomfortable, and then I just go with it. Actually, if you look at commodities, there's next to the list of the amount of cryptocurrency, whatever we want to define them as being, and I want to get into that. You can have a pretty long list of things, provided that they trade, the way that you thought they should trade. Yeah. Like you said, it's getting a little easier.
I set up an Ags Hedge Fund back in 2007 because that was another great setup.
Yep.
And I learned the hard way that it's not suitable for me. And the reason being is because they tend to mean revert. So my time horizon was like, I had a structural view that agricultural commodities were going to go higher, but the cyclicality was too big. And so it didn't work my time horizon. Your time horizon is different to mine. So it works much better. Yes, there is an issue. Sometimes you can get trapped in 5 limit down days, and that's pretty painful. But you can also get trapped in limit up days as well. Yep. So yeah, I found it just didn't work for me. I'll trade them from time to time, but I found they were less macro, but you're more price signal driven by the volatility structure, which is a different way and probably a much better way to trade ags, I think, than trying to figure out the weather in Kansas when you're based in the Cayman Islands and have no idea because every day is at 90 degrees.
Yeah, I don't, I literally spend less and less time as I get older and my hair goes completely gray on the why. Like I actually don't even give a shit most of the time. It's more the when, like when do I buy more? When is the cycle, from a quad perspective turning? So when is so much more important than why. And what I think you said, and when can be defined, I try to define it immediate term, intermediate term, long term. Like this discussion really deals in the intermediate to long term, and you can correct me if I'm wrong, but your time horizon from here on a big move in Ethereum is like the next 6 to 9 months. So I call that the intermediate term, but you're using the long-term tail, as I call it, to contextualize where that is. So let's just get into that a little bit more. I mean, because I think you've called it a regime shift, a regime change, asset allocation shift, and those happen, across human history, as we well know. But sometimes, like in 1999, by the time that 150 million users in the internet from 1997, became a bubble, and then it was still a regime shift. I'm pretty sure that Google was still right, but there was still a period of time of risk that was intolerable for many and suicidal for most. So how do you think about that? Because 1997, and again, we don't have to use a perfect. That's the danger of analogs. But if it is 1997, by the way, we've had 8 straight up days in the S&P 500. It hasn't happened since 1997. The internet's a pretty damn good analog. Look, is that an easy one, or is that one that just makes it like easy because it's so obvious and makes it fundamentally true?
I think the 1997 analogy just says It's going from here to massive.
Right.
How it gets there, I don't really know. I've got some reasonable clarity between now and end of year because there's a seasonality that is pretty observable. Beyond that, it becomes more speculative in nature because we don't really have the full signals. I think the adoption by institutions continues. And as we all know, they tend to do January asset allocation, particularly if it's a new asset class. Hedge funds have a new P&L. They tend to pile in. My guess is this cycle extends a bit further than people expect. But there will be a bear market. What is that going to look like? Is that going to look like the last one that we had? It's probably a mistake to think that because the players are different. Maybe it's longer. Maybe it's shallower. Maybe it's just choppy. Or maybe it doesn't do that at all. Maybe it just keeps having these sharp corrections down 50%. And then 6 months later, it's at new all-time highs again.
Yeah,
I just don't know.
Well, what we do know is, I mean, like recent history, like again, I really wanted to give you that, whatever it was going to be, 8 minutes or more, to just lay it down on the railway track. This is foundationally how I got here. Because I think, if you can, and you don't always have to stay like I have to be long this because of those reasons, but it gives people, me, which I want to know why, like on that, like what are the, really the fulcrum points of this guy's view when you take this kind of a position. And you said, look, right at the outset, limited supply, and it's basically an anti-money printing instrument. So what we do know is that today, central banks, if we slow, like I think we'll slow.
And that's just Bitcoin. That's not the whole space. That's just the argument for Bitcoin.
Just Bitcoin. But let's just say, like, let's say that it happens. We get another what I call quad 4. Every single time we get a quad 4 U.S. economic slowdown, the printing press comes in faster and harder, and therefore the corrections in crypto are shorter. I mean, that to me,
and equities too.
Anything. I mean, by the way, and as you know, Bitcoin and ETH are increasingly trading on a correlated basis to equities. Now, whether or not that holds, that's not really what I wanted to get into there. But I wanted to get into that anti-money printing generational view that could be much more so than just a regime shift. Where are you at on that?
So it was 2020. March to June period that made me reassess my big macro framework because we knew what the central banks would do, but they did it harder and faster.
Yep.
And what we ended up with was the shortest recession in all recorded history and the biggest recession. That never happens. So what we've done is we've created a reaction function in the central banks to do more. Yep. Because Janet and Jay will look at each other, high five, and go, we nailed it. The world stopped, and we only had a 2-month recession, and the markets recovered pretty quick. Now, we know that the reality of the underlying economy and other things is not so great, but for the central banks, they're going to do more of this. Why would they not? They're now thinking, do we need a business cycle at all? But what they're doing, if you actually look at it, the central bank balance sheets, the big G4 central bank balance sheets, are growing at about 15% a year. So I started thinking this through and then thought, I know a lot of people use M2 as a way of understanding printing, but I just thought I'm just going to use the balance sheets because that's new stuff that we know that they're doing. And I know that there's it's not a pure way of flowing into the economy, whatever. But anyway, so I put the S&P against the Fed balance sheet, and all of us have observed that correlation over time. And the thing was, it kind of told us what we deep down know is the S&P's kind of gone nowhere since 2008. It fell in 2008, the money printing came, and the S&P's basically been going sideways. And then I looked at gold, and it kind of had even underperformed the Fed balance sheet. I looked at real estate, it was identical to the Fed balance sheet.
Yep.
I then looked at the NASDAQ, and it had done better because it had all these network stocks in it. And then I looked at Bitcoin, it was like, oh, this is a whole different world. Mm-hmm. So there's only one asset that looks like it offset the printing of money. So if you know that and you are able to trade it, then let's say we go into your quad 4, what are you going to buy?
Right.
Well, the highest upside is going to be crypto.
Mm-hmm. Yeah, I agree with that. I agree with that 100%. And I actually don't want, unless you want to get into the risk management of it all, I have my own model. I have my own view on that. I'll do what I damn well please on that, as you know. But what I really wanted to get to is this intermediate to longer term view on how this guy that I got a lot of respect for is so big in this. Now, maybe just to show what you just said is obviously empirically accurate. Guys, can you show? I think it's slide 72 in the macro deck. We show not just the U.S. balance sheet, but we're looking at that 20 trillion. Obviously in global money supply. So this is, and that's in the last 20 months, okay? And that's very good, even if you're not, wrapping it on your own, stochastic chart right now, you're going to see that that's a damn good fit for what's happened to the crypto asset class. Now, you also said at the beginning, like again, just going back to the foundational premise of why you're so big in this, you also said, look, I started looking at this initially in terms of stock to flow versus gold. You can stock to flow like 2 trillion against the 20 trillion there, or more importantly, 2 trillion against the, 250, 300 trillion in assets out there. How obvious is that if the answer is always going to be, because again, they're just going to take share from what you just said, dollars, treasuries, the things that you and I would have gone back to buying.
So I looked at this and I looked at all the global asset classes. So equities, about 250 trillion, bonds, about 200 trillion, real estate, about 350 trillion. Derivatives, 1 quadrillion, FX markets, about God knows how many quadrillion. So I looked at that and thought, okay, we can see the trend rate of growth of adoption. We know that equities are going on the blockchain, bonds are going on the blockchain. The European Central Bank is already looking at the French Central Bank, a bunch of others. So that's going to happen. So bonds and equities go on the blockchain. People are already starting to tokenize real estate. Well, this is kind of a super asset. Now, I don't assume it eats all of them. It could do in the end, because they'll still exist, but they'll be basically on the blockchain. But if I'm right about crypto, then it's currently a $2 or $3 trillion asset class. And to be reasonable, it should be worth 200 trillion. Well, that's 100x, Keith, of an asset class, probably in 10 years. You and I, nobody, in fact, has ever seen that in all recorded history.
No.
And that makes, and what I like about it, why you say you're all in, is because I can be a total idiot, pick the wrong thing, much like you can do with equities, and you've been able to do since the 80s. You just pick anything and it goes up. And so it's kind of idiot proof. Now, yes, like equities, there'll be bear markets. But if I'm right, and we're going from 2 trillion to 200 trillion, the entire asset class is going up 200x. Now, it doesn't mean it goes up in price necessarily 200x, but the opportunity set's going to be enormous. Yeah. So that's why so many of us are focused on it.
Internally, I mean, if I had Josh Steiner or Rob Simone, who are two of the gurus internally, Christian Drake, we got a bunch of guys doing the work, so to speak, and I'm just trying to catch up to them because I'm like the neophyte as usual. But again, I'm just like focused on when, and the more you blow this out, the more I'm willing to believe that long term. What, of course, you could say is you could say a bunch of these asset classes that you just called out are going to get cut in half next time the U.S. economy slows, and now your reference point is 100 trillion, and this going from 2 to 50 or whatever it is.
I don't know, Keith, because they'll print money again.
Yeah.
But so what they're doing is lowering the denominator, so optically, everything looks fine.
Yeah, right. It's always a big high or low, but there's always, like I said, a moment of uncomfortable or in some cases bankrupting moments for people that are running with leverage now that we have. You can lever yourself up pretty uniquely here with crypto, obviously. Instead of getting into that, I actually want to get into what I'm sure you trigger people with, which is okay, why now ETH instead of BTC?
Because if my framework is Metcalfe's law and it's all about adoption effects, then you want to look for the communities or the tokens that are growing their ecosystem faster.
Right.
DeFi comes along, it's all built on ETH. NFTs come along, all built on ETH. The number of new wallet addresses growing is happening faster at ETH. So what you've got is the network is growing faster, and therefore the price should be going up faster. Simple as that. I mean, once you understand this Metcalfe's law thing, it's actually all pretty easy to understand. Mm-hmm. And you just have to abandon linear charts and use log charts. And once you see the log chart, you see the trend. It's pretty simple. It gets to like 2 standard deviations overbought versus the long-term trend. It then corrects for a period of time. And on a linear chart, it looks horrific. Everyone goes, see, this crypto's worth nothing. But on the log chart, just goes down to 1 or 2 standard deviations oversold and starts all over again. And it's the same that Google's done, Facebook's done, Apple's done. They're all the same.
Yeah, it's not. I mean, it's when we start to look at these, if you put it in the language of equity-only people, it's like, okay, I have these network stocks. Here's the TAM. Over time, I nailed it. Yeah, I mean, I don't think that there's any reasonable person that allocates assets under any regime shift or not that would be able to disagree with that. So it's interesting. I mean, so basically, when you say 100 to 300% upside or much more upside from Bitcoin from here, it's just that it's happening on a bit of a lag to it.
It's like, imagine if Facebook is growing faster than Twitter in terms of number of users and the activity. Facebook share price is going to go up more.
100%. So I use that
even
model.
Though
like
Twitter whichever one may be larger, doesn't matter. What we're looking for, you and I are there to make profit. So we want to back the fastest horse.
Yep, that's an excellent framework. That's excellent. Like, sorry to interrupt, but at least I've only done it once in 25 minutes. But when we try to explain to the old wall hedge fund manager the cemetery of people that have shorted expensive stocks because they're expensive, we always say, look, in particular when you're in quad 1 or 2, when it's a pro-growth environment cyclically, expensive gets more expensive because the growth rates relative to the alternatives are accelerating, both absolutely and relatively. Therefore, the multiple, I quite literally say, can be anything. It's going to be higher. I like it because it's expensive. So that's like you're at least when you're saying it this way, I'm finally at a point now where I could put what you think.
Well, that's exactly.
Into my
so
framework.
If you think of what your model intuitively does, it ignores valuation.
Right, 100% of the time.
It's essentially momentum in one way, shape, or form. All network stocks are momentum in one way, shape, or form.
Yep.
So you ignore value. Well, the valuation can be this Metcalfe's law, but basically it's a momentum play built around network growth. Same as it is for Facebook, same as it is for Tesla. And so you can own Tesla and everybody will shout at you, you're an idiot, but it doesn't matter because the network effect of Tesla is growing, or in your case, the momentum remains in place.
Yep. I mean, momentum works both ways. And as we've proven through the back tests of all of market history, again, when the economic momentum is at your back, and that can be, if growth's slowing, it's at the back of treasuries, and gold for that matter, if you have an economic stagflation. Or it could be, pro-growth stocks, or networks. I mean, this is, I'm accepting this, not finally. I've been long this stuff. I've just been trying to quite figure out how to put it in my framework.
The issue is, Keith, and you've seen this, is you walk into the space, say, I'm kind of interested.
Yep.
I'm going to see if I can use my framework. Everyone attacks you because you don't believe, and that's Bitcoin. Not Ethereum, not the other networks. It's basically Bitcoin because you've come in and you don't really care about their philosophy or the structure of how they think about it or their notion of hard money versus other things. That's okay. They can have their reason for owning it, but you have a different reason and you have a different time horizon and they don't like it. I think the broader space is more accepting.
Well, I think that's the problem with everything right now. People can't actually have a real conversation like this where there is a back and forth trying to empathize with and understand the other person's view. I don't want to go off, ideologically or politically on that, but that also presents a great opportunity because it presents a great opportunity for guys like us that have built content platforms that are meant to engage in civil and objective debate. I mean, that's a great thing that you built, Raoul. So when you really look at it, I mean, the Real Vision content platform, that's why we can have this conversation. That's why I can actually learn on the fly here, I think I like to try to in life, and end up maybe I didn't have to believe what you said. I didn't know what you were going to say, but I listened, and that's where I'm at on that. Now on the because I think you've said, okay, look. We've put out the Metcalfe's law. We've put out the addressable market caps of everything that ticks. We agree on obviously money printing and the limited supply nature of crypto. Now you have millennials that are the ones that don't want to hear from somebody like me that does risk management. You might say, well, that's how millennials are. Because they don't. I think you've said, actually, I'm sure that you said this because it's coming to mind. They're not like boomers. And my dog's named Boomer, so be careful with this one.
No, and nor should they be. I did a video that became, I don't know, one of the biggest videos I've ever done. It's like 2.5, 3 million views, called The Retirement Crisis.
Yeah.
It's on YouTube. And one of the things I said is, listen, if you are a 30-year-old millennial, you're pretty fucked right now, because the expected future returns out of equities with all-time record high valuations and the boomers needing to sell them over time, same with real estate, same with bond yields, your ability to generate the same kind of wealth that your parents generated, the baby boomers, is precisely zero. And I actually said you've got one chance, and that chance is crypto. Because you can take risk at your age because you've got nothing to lose.
Right.
So we all know there's two times to take risk. One is when you've got nothing to lose, and one is when you can afford to do it. So when you've got nothing to lose, that was March 2020 into September. They've been given a check, $1,200, not going to change their life. They're stuck at home. They don't need to spend it. So they go on Robinhood and they discover call options. Brilliant. And guess what? It worked. And suddenly 86 million millennials got financialized all at the same point. But they're risk takers. They understand crypto. They understand risk taking from gaming. It's very different. We were taught different things, and the parents of the boomers were the silent generation, and they were much more risk averse because of the back of 2 world wars. So now we've got a group that have never seen stuff like that before, who have a lower wealth at their age than any previous generation in history, and they've seen an opportunity. So they're going to swing from the fences. And that's changed the structure of the option market. Makes me laugh because everyone's like, the option market's crazy. Look at this complete exponential use of options. This is a bubble. No, you've just bought 86 million millennials and probably, I don't know, 50 million, 70 million Gen Z into the investing base and give them Robinhood options, and they can't lose more than they put in.
Yeah.
Go for it. Why the hell not? We all have to learn the hard way, and we also need a few victories. And that way, they might be able to speed up that process, because you can lose money pretty quick, but you can make some good money quick too. And what's really interesting is these people are all coalescing on a platform like Reddit and talking about their losses, Keith. Our fucking industry is built around, excuse my French, built around people who don't want to talk about losses because it makes them look weak. These guys are laughing at their losses and saying, I learned from it.
Yeah, that is so on the screws, man. I mean, we're running this Hedgeye on the prize competition right now, and the best part about the coaching sessions is interviewing real human beings that aren't from the old wall. And 100% self-effacing, giggling, laughing, mocking themselves on mistakes, their former selves, et cetera, especially millennials. Now, that's counterintuitive to a boomer just like, I don't like millennials or whatever. But there's also this generation which has, less, us fucked up people like that are from Gen X that have, seen this movie before twice, where it was different this time. It was regime shift, internet, 1999, kaboom, real estate, obviously after that, kaboom. So we're like as Neil Howe would say, Keith, you're just fucked up. Yeah, you got all these issues. That's, and I'm okay with that. But it doesn't mean that risk management of asset classes heading into new cyclical economic regimes, which is now I'm going back to what I focus on. That doesn't mean it's not going to matter. I think what you said is that it's going to matter for a shorter period of time. But what is it about not having to have learned a lesson yet that could be the problem here?
I'm not sure there's a problem here, because if we get the younger generation to treat this like 401ks that we were forced to do, which is bear market, bull market, just dollar cost average.
Yep.
That actually works to generate wealth if an asset's going from 2 trillion to 200 trillion, right? You should do very well. So you don't need to trade it, you don't need to do anything, and you shouldn't care about the bull or bear markets. Now, some people want to trade it. There's a lot of leverage in the space. Not in the US so much, in Asia, and it tends to be pretty short-term leverage. And what's interesting about crypto leverage is it essentially works like an option because it gets liquidated. So you can't end up with unlimited losses. So it's actually quite interesting. But I think that, there's going to be periods when we hit the Goldilocks point in the economy. The central banks aren't printing, and it's that extended mid-cycle period, and crypto shouldn't do that well. And people will start to look at other assets and diversify. And, that's what I will do is, over time, I'm 100% crypto now. Will I remain 100% crypto? Without question, not. Because I'm out to maximize my returns and minimize my downside. So, but if you're young, you can just keep dollar costing averaging, and you actually want the bear market. You actually want, if you'd have dollar cost average, which none of us did because we're all Gen X cynics, if we dollar cost averaged the NASDAQ over that sell-off in 2000, we'd have done pretty well.
Yeah.
But we didn't, because we're two miserable old cynics who say, well, there was a bubble and that taught you all everything. Didn't teach anybody anything. As you said, Google, Apple, Microsoft, they did just fine. They didn't get to new highs as quickly. But if you look back now, considering we're talking about dollar cost averaging, so you looked back 15 years later, suddenly you've outperformed everything all over again. So we need to be careful of our Gen X cynicism. But I'm a cycles guy, as you are, and I will trade the cycles. It's as simple as that.
Yeah, there's a great book by Adam Grant, which you may or may have not read recently, where he just gets you there. I'm there. I mean, the three pillars of my framework, one of the biggest ones is behavioral psychology and big shifts, like how you have to start thinking, on a nonlinear basis. This is quintessentially like, again, if you try to put where we are today, wherever we have the next crack or correction, in the same static box of your options yesterday, you're going to miss what millennials and a lot of people have just moved forward as their next set of options, which is not dissimilar from tech stocks, by the way. There's always the next. There's always the next, and I don't have to look back at things that I've always looked back at. I mean, and that's one question I have on that. Like social communities, tokens, NFTs, to me, that's that next place, right? Where even I have some of those. I'll admit it. We own this digital professional token team that we bought with some professional athletes, and I'm like, sounds cool. It goes up every day. Value.
So Keith, it's pretty straightforward. Hedgeye has a community, Real Vision has a community, and our communities overlap, which is why we always enjoy talking to each other, and our communities enjoy it when we get together.
Yep. Those
communities, once you add a system of money in a community, what you're doing is you're incentivizing everybody in that community to grow that community and to benefit in that community. Mm-hmm. This business model is gigantic. And I have spent time speaking to the world's biggest music artists, media companies, membership clubs, everything. And everybody goes, oh my God, I get it now.
Yeah.
The NFTs are just part of this.
Yep.
So everything is going to tokenize. Disney will tokenize all of its franchises and Disney itself. There'll be a Disney token, and Disney will essentially be a digital sovereign state. Mm-hmm. Because you've got huge community, billions of members. You own the Disney token, so you're now part of that network, and you'll probably have the token of, let's say, the Marvel comics or Mickey Mouse, whatever sub-communities. So these are tokens as well. And there'll be NFTs, which are scarce digital assets, which we can collect. And all of that ends up being into the metaverse, which is the kind of the more broadly digitalized world that we live in, as opposed to it being, one game owned by somebody. It's actually just this digital world.
It's not like Squid Game. We don't die. It's actually a game where everybody lives, and actually the people that run the game don't get all the money. It's like Josh Steiner called it a while ago. My partner here, who does a lot of leads our crypto effort with Christian Drake. He wrote this note called the Cantolon Effect, and I think a big VC guy wrote something similar recently.
Sahil wrote about it yesterday. Yeah.
Who's that?
Sahil Bloom.
Okay, but I saw that in a headline somewhere. But that Cantolon effect is like you talk about Metcalfe's law, but the Cantolon effect as well. Maybe hit on that quickly, and then I have one more question. Then we'll get to other people's questions.
What we're doing is, in the current state of affairs, equity holders make the money, and everybody else gets monetized. This community model means that everybody shares. And so you can actually think of this as investment becoming a culture.
Okay.
So let's say you invest in Rihanna's token, and Rihanna has another hit album and a massive tour, and everybody's talking about her social media. Her token's going to go up.
Yep.
You're a fan. You're creating videos around it, doing content because you're really involved in the community. And the more you do, maybe you earn more tokens, or maybe the token goes up because you're helping the community. What you've made is investment in culture. Mm-hmm. Culture has now become an investment, which it wasn't before. You'd have to just buy goods, and that was it. And you felt good because you're part of that community, whether it's, Nike trainers or Apple phone, whatever it was, whatever community you thought you were part of. This way, you're actually part of that community, and you create universal basic equity.
Yes.
That's a big concept.
That's a huge concept.
So a Gen Z or younger can discover a new game, which none of you and I will never discover because it's not our generation. They'll discover a new game. They'll go, oh my God, this is amazing. They will own the tokens in it. They'll want to own more tokens in it because they think it's amazing, and they will make money. That is already happening.
So this is exactly what he's 14 years old. And again, one of the many reasons why, we could have this conversation for 5 hours. Unfortunately, I got to keep it tighter. But the fact of the matter is that what you just said you said Rihanna, right?
Yeah.
Yeah. So I get in the car, like usual, we're driving to hockey practice, and my 14-year-old son starts explaining the exact same thing within this this hockey video game that he's playing, and how he's finding different players that people don't really know, but their value goes up when they play well, and he's betting on them. And he starts asking me, because this during the pandemic, we opened his trading account. So all he wants to do is talk about investing in those, not buying Microsoft. And it's so obvious when you say it that way.
And watch his risk behavior. He will take more risk.
Well, he doesn't even know what risk is, but he goes with his knowledge. I think that's what I'm comfortable with.
But he's taking risk in a game, and if you were to look at how he runs his portfolio of assets in that game, it'll be quite risky.
Yeah,
that is what they learn from gaming, and they take it to their investing lives, and they're practiced at it. So we all do what we're practiced at and we understand. So watch this as well. It's really fascinating how they take risk versus how you would in the game.
Because his Gen X dad, both he and two of my 4 kids have had to go through this with me at night, which is speed monopoly. So I show them how they can blow up with leverage. And they don't quite get that yet. And maybe it's healthy that people don't think that can happen. Because if you are using, crypto futures and options, and you're getting into some illiquidity traps, that might happen. You might learn something. But again, I think the point is that they keep pushing the envelope to the next place to go, which is a place that nobody really knows. Because we generate, every generation has. This fits quite well, actually, with Neil Howe's Fourth Turning. I don't want to go there.
I mean, I'm a huge Neil fan. I've read that book maybe 7 or 8 times. I read it every 6 months without fail. And every time it's like the guy's a prophet.
Yeah.
This is all part of it.
Yeah.
When you talk about breaking down the old institutional infrastructure, this is it. We're breaking down money, the system of value. I mean, the whole thing, the system of sovereign states is changing because we're creating sovereign states online. So that book has been really good. And, it's really interesting because there's a lot of boomers and Gen Xers who've read that book. And they kind of were expecting the world to return to the world that they knew, and the madness of change would disappear. I'm like, no. Neil's explaining to you that the change is going to be gigantic and incomprehensible, and the young will see it and we won't, and they will be our guide.
That is 100%. You have a uncanny way of summarizing some big shit, man. Big picture shit. Last question that I have before I take other people's questions. So the problem with this, it's not a problem. It's what's happening. So it's not a problem. It's an opportunity. We invite the boomers to this community. We invite the institutionalization of this. And what I wrote about this morning was, hey, start paying attention. There are patterns here, emergent properties and fractal patterns that look very similar to how even oil trades into options expiration, for example. We're seeing more institutional hedging because that's what they have to do. So when Mike Saylor says, hope.com, I'm like, there's this, you invited them in. Now they have to deal with their shit, which is they'll get tapped on the shoulder if they don't delta hedge and reset their hedges, because there's an increasing amount of Gen X, boomers, millennials too, a lot of their analysts are millennials, that are engaging with this asset class, particularly Bitcoin, the way that they would anything else. Is that a good or a bad thing?
It is just a thing. Who are we to pass judgment? As you say, what's going to happen is institutions are going to rebalance every quarter.
Yep.
If it's gone up a lot or gone down a lot, they'll be taking opposite flows. That actually gives market depth and liquidity, as we know. But it may dampen volatility. So over time, it lowers the expected future returns because the risk reward, if you've got less volatility, you're likely to get less upside over time. But that's a function of network adoption effects anyway. And you see the curve go less exponential over time as there's more adoption. So you're dead right. People are going to have to get used to it, which is why I've kind of made that potential call that this market will probably elongate longer based on this very fact, because institutions going into a new asset class will say, you know what, we're going to do this in 2022. So they've made the decision. They've been onboarded by Fidelity or Coinbase, and they've done all their homework, and they've had their trustees accept it. They've done all their paperwork. January's about the time they'll start investing. So even though the crypto cycle in the past was more retail driven, it's likely to elongate because of institutions. And we saw this in the commodity markets in the early 2000s after Goldman launched the GSCI index products and started getting institutions into commodity index futures and commodities themselves. It changed the structure of commodity markets for a while, and probably still has done.
That's for me and anybody who's remotely considering Hedgeye Nation, its process, et cetera. That's a very good thing, because now I'm looking at all the way back to what you started with, was what's my fundamental premise? How does it trade? It's increasingly trading and I hate it when people hate on me on this. Actually, I don't mind. When I call Bitcoin, it fits in my commodity bucket, and my max asset allocations are derived on historical volatility. That current realized volatility is really undergoing a regime shift potentially as well, which makes it easier. Like you said, it's getting easier to buy the damn dip. Like right now, for example, you got a huge implied volatility premium that's ballooned in both ETH and in Bitcoin. It's like, buy the damn dip today. This is like, I wouldn't have never said that. I never said that before. So let's just start with that. So we agree on, again, institutionalization can get broader adoption, I think is the point.
But the point being, Keith, is here's something interesting for you. I'm actually setting up a fund of funds in the crypto space. There's only $1 billion, I think, of original sourced investment in the crypto hedge funds. They're currently the space is worth $4 billion. 4 billion.
Yeah.
I think it's like 4 trillion in hedge funds or more. I don't even know what the hedge fund number is these days. But there's $4 billion in crypto hedge funds. And 3 billion of that has come from performance.
Yeah.
So, but the space is expanding to 9,500 tokens, plus all of the NFTs, plus the social tokens, plus DeFi, right?
Yeah.
We can't get our heads around it. So the alpha that is going to be generated in that hedge fund space for the next 10 to 15 years is unprecedented, because there is not enough capital in the space to bring the alpha down. So it is an extraordinary thing. Again, these things I've never seen anything like before.
Well, I've never seen, the first question, by the way, if you don't mind, I'm going to just jump into these, or I'm going to get into trouble for not asking you other people's questions. And it actually has to do with one of my colleague, Josh Steiner, because he put out this, he showed this model that had Bitcoin going to 1 million. So Rich is asking, Raoul, is that even possible? Like $1 million Bitcoin? And over what duration, how do you see something like that projected?
Okay, so let's go back to my framework, network adoption. That chart that I've put on Twitter many times about the adoption suggests we go from 150 million users to 1 billion users by 2024.
Okay.
We'll be at $1 million in Bitcoin, no question.
So you just get, man, that's not a stretch,
No, it's not really. When you think it in those terms, if I said, oh, the Apple phone, there's 150 million users, going to be 1 billion users. Is the Apple share price going to go up a lot? Yeah. Will it go up 10x from here? 20x? Yeah. It's not a big stretch. People just forget because they all get trapped in these narratives. It's money. It's this new thing. It's not based on anything. Just forget it. Are people using it, and how many people?
Good. All right. Raoul, this question is from Willie. Raoul, what do you think, and these are ranked questions, so I'm just going to ask the ones that are highly ranked. Raoul, what do you think is probable that a central bank will quietly try and become the largest holder of BTC as a hedge against the failure of their policies?
I'm already seeing sovereign wealth funds in the space. Mm-hmm. They haven't made a big play because the space is not deep or liquid enough yet, but they're coming. And, and it's the ones with the big dollar reserves, the Singapores, the Middle East, stuff like that. So it is coming. So are the central banks going to do it? Who knows? Not yet, but it will come. I think first, the next big thing is we're going to hear the story of sovereign wealth funds putting it as a long-term asset on their balance sheet, whether it's Norway, Abu Dhabi, Saudi, Singapore, and that'll usher in the next wave. And that then makes it unlikely that the central banks won't start doing it. Which central banks? Who the hell knows? But somebody like South Africa could really do with this because of the volatility of being part of the dollar cycle. Mm-hmm. It's a bit of a pain in the ass for them.
Yeah.
So something that they can have a small allocation to that maybe offsets the dollar cycle helps them. So some of these commodity countries, I think it actually makes sense for them. And they'd have to model it out and look at it in their portfolio and see what it does over the cycle for them. But it would help this boom bust emerging market cycle that keeps going on.
All right. I'm just going to ask you proof of work versus, there's a bunch of questions on this. Proof of work versus proof of stake. What's the difference and why is ETH better?
I don't say they're better.
Yeah, you don't
proof
say
of work of proof of work, Bitcoin is hard to do. You need these mining rigs, complicated maths, a lot of energy. It is the most robust, secure network in the world, which is Bitcoin, which is why it's amazing. Proof of stake is you've got tokens and you secure the network by promising it to the network and you get a yield. Keith, if you want to stay in ETH, you can generate yields now. So you've generated a long-term savings market in these things. So as you're seeing, a lot of the art market is now being priced in ETH. There's a ton of stuff on the internet being priced in ETH.
Yeah.
So you can hold ETH savings and have pretty much a risk-free return by staking. So staking allows it to be faster and kind of adds a bit of flexibility to it. And again, people don't want Bitcoin to be faster or more flexible. They just want it to be perfect as it is, which is incredibly secure, highly distributed network. But for Ethereum, I think it's a game changer because it means that at the end of the cycle, I'll probably keep just some ETH as ETH.
Yeah.
Because if I'm getting paid a 10, 15% yield on it, and I know that in due course the cycle will pick up again. So over 2 years, 2 or 3 years, a bear market, bit of a sideways market, I've picked up another 30, 40%.
Well, that speaks to my risk management years and full cycle return. I mean, is this part of it? I mean, you staking, and this is gonna anytime I start talking crypto talk, flippening. Is that one? First of all, is that the right word?
Again, the flippening is a bad narrative. Again, it came out of the tribal warfare between Bitcoin and Ethereum.
ETH. Yeah, right. So you flip out of Bitcoin into ETH.
And the flippening is when the market cap of ETH is larger than Bitcoin.
Okay.
Now, I think that's going to happen, not because I think Ethereum is a superior asset, because they're two entirely different things.
Right.
One is a kind of this pristine collateral store of value asset. The other one is basically a technology platform that's the fastest growing on earth. Is that going to be worth more? Yeah. Now, there is an argument that Bitcoin ends up becoming the kind of monetary system for the entire world. Yeah, but I'm not sure I'll be alive when that happens. What I'm trying to make is make the best bet that I can do over the next few years. And that's what I think the flippening will happen. Does it happen in this cycle? I think it might get there. And then maybe that's when the bear market starts, when everyone's like, well, see, Ethereum's king, and then everything falls apart again. So, as you know, people need to be very nervous of hubris. So we'll just wait and see how it plays out.
Yeah, that, again, it's kind of back to that tribal point, but at the same time, you have a view, and I think it's at least what resonated most with me within my framework is that relative rate of growth versus Bitcoin. I mean, you want to own the fastest horse in the race, not the one that already won X part of the race and is, there in Kentucky.
It doesn't mean if your risk appetite is less,
right?
You can own Bitcoin and you'll do fine.
Right. Now,
I'm not saying Bitcoin's going down or anything else. It's just I'd rather take more risk at this point in the cycle and be rewarded with higher returns potentially.
Yep. Now, I somehow found my way to Kentucky there. I'm actually wearing an Evan Williams Kentucky Bourbon Distillery shirt when I was trying to figure out that whole business of former Triple Crown horses and how you find the next one. An amazing exercise to watch, but in the crypto world, what is that next horse? Like who next to? You go Bitcoin. Next to Ethereum and Bitcoin, who's the next that you think could be the fastest? We go
back to the framework. So we avoid the speculation.
Right.
We go back to the framework. And what we're seeing is Solana has network effects. It's being used all over the place because it's cheaper and faster than Ethereum.
Okay. Cheaper and faster than Ethereum? Really?
Yep. But it's more centralized.
Okay.
So it's not as... So again, you're going out the risk curve and you're finding solutions for people who need it. So Solana, brilliantly, you put it against the chart of Ethereum 2017, it's a perfect match. I mean, it's like everything is a fractal in this space. So it's got network effects, provable network effects. The other one that's got provable network effects but is earlier is Avalanche, and the other one is Terra Luna. Those ones have provable network effects based around being an alternative to ETH. And I think that's fine. Now, there are many others that don't have provable network effects that are showing the price action that they do. Stuff like Cardano, where there's a bunch of owners of the asset, retail, but not enough activity on chain for me to really think, you know what, this is the next big thing.
Yeah.
It may be something that's more overpriced. I've not really done the work on looking at it that way, but I will do at some point if I can build out the full netcast law model on this. In fact, I'm doing a lecture at MIT this afternoon with the guy who is researching his PhD on network effects and netcast law. So I'm going to try and pick his brains on some of this stuff.
No, this is awesome, man. Like, if only because I can understand what you're saying and put it in my framework. And to me, like, that's a good thing because it stops me from having to. It's one thing to have a regime change in asset classes. It's another thing to have a regime change in shorter-term economic cycles. It would be entirely another thing for me to not be able to invest in something within the framework I've built for 22 years. That again, it's fractal, it's nonlinear, it seeks. When in a hedge fund community that I used to live in that seeks certainty, watch Billions. How certain are you? How willing are you to go to jail for that certainty? Like, I don't give a shit about that world anymore. All I want to know is that I don't know. And what you just said is like, it sounds like, correct me if I'm wrong, just like I drop 500 tickers into a certain model and it can be any country, currency, whatever it is, anything that ticks. And I'm perfectly willing to buy or sell anything if again, it starts to trend and accelerate. You're right. I love momentum. And it could be anything in this space because anything's anything.
So here's what I did, and people were like, what the hell is he doing? So Dogecoin, right? This is this meme token that was set up as a joke and became massive.
Yeah, my barber owns a shitload of it. She's just like talks to me every month. I keep it tight.
So I looked at this and thought, okay, what we've created is a meme, a culture that people want to be part of. Mm-hmm. Then nobody thinks that Doge is like the best asset in the world. They know it's a joke and they want to be part of that culture.
It's awesome.
So I'm like, okay, this is powerful because this is what your son will understand. So I thought, okay, so that's one side of Metcalfe's law. There's a bunch of people using it, holding it. What happens if somebody finds a use case for it? Along comes Mark Cuban and says, we're going to accept it. Dallas Mavs games for merch. And then Elon starts saying, I'm really interested in this. It needs to be speeded up and cheapened a bit. But, if I can encourage the community to go back and redevelop and help move it forwards, I'm interested. I think he'll end up using it in his cars for streaming payments. as we go into smart cities or whatever format it is. So I actually took the punt to say, I think there might be use cases because I can see there's a strong community. Why would you not build a use case on Doge? Why would you not when millions and millions and millions of people own it? Of course you would. So, that's me going out further on the risk curve saying not all my Metcalfe's law attributes are met, but I see a probability that we could meet them. And if that's right, then the price could go even further.
Well, just the to even tighten that into a tighter OODA loop, like when we start to observe, orient, decide, and act on these shorter term price moves, it's always about probabilities going up or down. I'm assuming, just like I assume in all markets, when something's going up or down, somebody knows something. Somebody knew that Cuban was going to do that, and the probability started to rise that it was going to be that. And that is really what I think most people in all markets, whether they be crypto or otherwise, macro broadly, which I put crypto in there, should just accept. You don't know anything about the future or other people's plans of it or whether people will believe it. And even if they believe it, if it will be true or not, you can make a lot of money playing probability curves changing.
That's all we do. All we're doing is assessing the probabilities. We may have a future potential end state in our heads, but I'm sorry, you and I don't dictate markets. It's irrelevant what we think. We're just creating a mental map to be able to follow what we're thinking. That's okay. And you can do it in a model, you can do it in a mental map, it just depends how you operate.
Right.
But the change in probabilities, you talk about rate of change all the time, is the entire game. Mm-hmm. Now, if you get it right, you're basically saying, I see a potential future, I think the probability is higher than the market is pricing, and you capture that. Mm-hmm. That's the entire game.
And what I love about that game versus the game, you and I, like I said, you're looking pretty young here, man. But we're old dogs playing in a new game, and we've been very willing to change as the game changes. A lot of old dogs look a lot older than we do because they're not in the game anymore because they couldn't change. And I do think that, for me, when I think about this, it's a wide open net. The old dog would call the Bank of England. His cousin would work there and put that trade in at where. That is a closed network. That is for the privileged. This Mark Cuban example, or pick Rihanna, all the examples, my son, it's just somebody coming up with an idea. Could be anybody.
And guess what? The crowd is smarter than the guru every time.
Big time.
Once you educate the crowd, which you and I have spent the latter part of the chapter of our lives doing, is that well, it is, but you and I both tried to do that for the last 10 years or so. And what's happened is, and we've proven it by crowdsourced the Real Vision bot, which is not actually a part of Real Vision yet, but it's been surveying our community for asset allocation in crypto and traditional macro, and they've outperformed the experts and outperformed Bitcoin. And even their asset allocation, because there's no committee that sits down and says how they should do things. One day something's in, one day something's out. It's a weekly asset allocation. It's outperformed. The crowd is smarter than the individual, and people are going to have to get their heads around that. In the past, Keith, it was all about who had the information. In the past, it was the hedge fund manager like me at GLG, or the guy who's running the sales desk like me at Goldman, who had all of the information. Now the crowd has it, and they're smarter because they have their own skill sets and experiences. So if you add your son's perspective to my perspective to your perspective, it's actually better than any one of us individually.
Mm-hmm. I love that, man. And I was on the tip of my tongue. I almost said I love you.
I'll take that. It's fine.
Well, I just said it. I do. I love the passion you bring to the game. I love the fact that people question, your premise on this position. I love the fact that you just pounded a framework right down their throat that was very consistent, and you always went back to it, and you gave somebody like me an opportunity to learn how to, tangentially, or at least consider how to put it in his own. That's awesome, man. I do love that. I do love you. Thanks for doing this.
It's good. As you and I have talked about a lot, it's about being open-minded.
Yeah.
We don't know everything, and we're trying to figure this out. And when you've got a regime shift, and again, I'll thank Neil Howe endlessly to the day I die, is once you understand that you are in a regime shift, then you just wide open everything. You say, you just go with the, I do not know anything. I have some understanding of how the world has worked. If I can bring this to the new world, great. If not, fine too. But don't look back and say, it shouldn't be like this. It won't be like this. You're all idiots. The kind of bitter, I fear change, that's not going to get you anywhere. That's going to end you owning gold, which has gone sideways for a year.
Well said, my man. Well said. We even went overtime. I hope you don't mind. But it was that's a real conversation. Thank you. All my thanks. Very grateful for Raoul Pal's time.